Today, I am joined by the one and only Brett Schaefer. My name is Ryan Henderson. We do these shows weekly on Wednesdays at 10:30 a.m. Pacific time, 1:30 p.m. Eastern time. We do these live on YouTube. So if you ever want to get any questions in, go ahead, head on over to YouTube, look up Chit Chat Stocks, and you can comment any questions or feedback you want for us. We always appreciate the comments we get. And on the show, we talk all things financial markets. We riff on the world of investing, and we've got some topics slated for this week. I've got some actually fun ones. We got a recommendation last week for our small cap of the week, which I'll be talking about. But Brett, I guess welcome to the show. What do you have on our docket today?
Yeah, it's going to be a fun one. You got a lot of stuff. Boeing union strike. Things seem to be going quite well for that company as well. Always AI spending with Oracle. Classic. You'll never guess, but they are bullish on the potential of AI and how people are going to give them money for cloud computing. And I'm interested in that small cap of the week. We also have a question about emerging markets, which I think is fun. We can talk about countries that interest us and why. And I think that's always a fun discussion because it's scary to move outside of the US or outside of whatever home market you're in. I think we can learn a lot, and we're going on that journey with everyone.
Before we do, though, I want to talk about our friends at Public. If you want to earn a 6.9% yield for the next 4 years or more, you need to check out the bond account at public.com. It's a new way to invest in a diversified portfolio of bonds and receive monthly interest payments. The best part, if you act now, you can potentially lock in a 6.9% yield until 2028. In other words, no need to worry about the Fed's upcoming rate cuts. With a bond account at public.com, you can earn a 6.9% yield even as rates fall. It only takes a couple of minutes to get started, but you have to act fast if you want to take advantage of some of the highest bond yields in years. Discover how you can lock in a 6.9% yield until 2028 with the new bond account only at public.com/Chit Chat Stocks. Where do we want to start, Brett?
Ooh, I don't know. What do you think about this? I was going to say Boeing union stuff, but I'm not sure everyone wants to even talk about that. Let's do Oracle. That's sexy. That one seems fun. And, Larry Ellison, he's looking spry. He's 80 years old. He just turned into the richest person in the world again, I think,
Really?
for a brief moment, which feels, like, hey, I've kind of been in this. I've seen this movie before, circa 1999. But what did they have to say? How is their business doing?
Yeah, business seems to be doing well. I guess I did not realize this, but one of the biggest AI beneficiaries is potentially Oracle. They are one of the biggest data center operators globally. And apparently all this AI spending is somehow helping them. I'll be honest, don't know Oracle's business model very well at all. It's not something I've ever studied or really even had much interest in studying.
Databases, Ryan. Databases.
Yeah.
That's sticky.
I bet it is. And so I guess what happened was they came out and had better than expected earnings, but then they also raised their 2026 guidance, which I was like, all right, that seems a little forward, right? Like, I think that's 2 years out for them.
Well, maybe they're on a
Different fiscal year.
Yeah.
Anyways, but then either at a shareholder meeting or in some sort of a conference, they said that they expect to surpass $104 billion in revenue in 2029, which...
Okay, that's aggressive.
So either it's a red flag that they're giving 2029 forecasts, or it's a testament to how predictable their business model is. I'm really not sure which. And the stock soared on the news. Basically, a whole bunch of quotes around how all the spending from the major cloud providers and the companies that are spending tons and tons on CapEx seems to be flowing through to them, and they expect revenue to double over the next 5 years, which for a business of this size, this scale, that would be huge. I'm sure there'd be high incremental margins on that as well. So profit outlook looks good for Oracle. I believe the earnings multiple has basically doubled over the last couple of years.
I was about to pull that up. You're reading my mind here.
Yeah. So
ratios.
Larry Ellison,
I'll give a good share.
still the largest shareholder, I believe, of the company, surpassed a one Jeffrey Bezos. So congratulations to him. I'm sure he doesn't care. I'd be surprised if he spends that much time really focusing on Oracle. He seems more like an eccentric character. So um, anyway,
Yeah,
yeah.
he
What
did
are your
say
thoughts
in
on all
a
this?
yeah, he did say in his book or the book that was written about him that he thinks he'll be known more for his Japanese Zen garden that he built at his compound in San Francisco. So we'll see about that. But they carried down, I believe, he custom got a truck and carried down boulders from Yosemite. Maybe not in the national park, but where it was legal, obviously, and put them in his backyard. So he's an eccentric figure. That is true. I mean, can we get Cisco back in this even? They got to be kind of like, all right, well, maybe, you know, maybe we deserve to be doing this. Maybe we deserve to get
So,
back. If Oracle's soaring, if Microsoft's soaring, if, you know, we're talking
yeah.
about AI infrastructure, hey,
And
I feel like I'd be jealous.
on the flip side, I think we can skip to this segment as well. So Oracle, AI darling, I guess. Didn't see that coming, although maybe I should have. People said that was kind of like an obvious beneficiary. Snowflake's chief financial officer came out at a conference this week and took a stance that I really haven't heard a whole lot of executives be basically in the ballpark of. Like he said, direct quote here, I'm not going to buy any more GPUs until I see the revenue to support it. Now, I think this was a lot of people took this kind of out of context, which was it was in reference to the soaring costs of GPUs because there's the lack of supply at the moment. But any way you slice it, the statement is still clear. He's not buying any more GPUs until he sees the revenue to support it. Maybe if costs come down, he'd feel a little more incentivized to buy some more GPUs. But basically, it's pushback on this AI spending until he sees some sort of benefit from it. So, and I posted this. A whole bunch of people commented, "All right, like you're going to be dead in the future. Like, you know, you got to invest now for the revenue later." You know what? I honestly, I don't know if I disagree with the guy. Like, you can generate good business returns without needing to buy endless GPUs. And I know everyone wants to talk about the investments in AI and being that, but you can serve a lot of value to customers, even if you're Snowflake, without having a ridiculous amount of GPUs. I know that's kind of a hot take, but
Okay, that mentality, Ryan, and I've talked about this time and time again, is exactly like Cisco in 1999, is exactly like telecom and the fiber builders in 1999, 2000, 2001. That the history might not repeat the same way, but that mindset is similar. And I don't think Snowflake can be complaining, at least from a top line perspective. I know people worry about, well, their underlying profit margins, the consolidated margins are quite bad, but the gross profit, the unit economics seem to be quite strong. If we look at this chart here, gross profit since January 2019, so I think that's honestly the calendar year 2018, but fiscal year 2019, it's grown at 100% plus compound annual growth rate through the last 12 months, gone from 44.9 million to $2 billion. I don't think these are nitwits. And there's such a consensus around you need GPUs, you need whatever. Are you ready to call the top, Ryan? I know this
eh,
on Value After Hours, like when they ask what inning it's in, it's kind of the same question, but are you ready to call the top psychologically? Put some psychological shorts on.
I don't know, because on the one hand, first of all, not in love with the way that Snowflake kind of runs its P&L. Stock-based compensation is ridiculous. And the other part here is it's different for different companies, right? Like we got a comment here that says AWS, GCP, and Azure can't find enough GPUs to meet customer demand. They might have applications where like the spend on GPUs is warranted. Like they can see a direct revenue correlation. They can see how it benefits customers instantly. Snowflake, I'll admit, I don't know the product that well, but maybe they don't need it. Maybe, maybe some sort of conversational AI or whatever it is you're looking for, it doesn't really fit their customer needs.
Yeah, and
Whereas
look, yeah, go ahead.
I was going to say, it could be very beneficial for Amazon, for example, with Code Whisperer. If they've got a whole bunch of developers using that, like, and they want to keep training it, whatever it is, it makes sense for them to keep spending on it.
Yeah, and one thing I would say is Amazon, Google, Azure with their cloud computing stuff cannot, the demand's quite high right now. But the demand is high because there's companies like OpenAI and Anthropic which have tight relationships with some of these customers that are spending an absurd amount on cloud computing credits while simultaneously running, you mentioned a P&L that's probably 10 times as ugly as Snowflake's. The reports are that OpenAI is losing an absurd amount of money, which is why they are trying to go to the capital markets again to raise over like $10 billion, I think. So, hey, if that can continue, sure, that's great. But you're betting on either a change in the unit economics or pricing power, or that VCs just keep wanting to throw $100 billion at these things that go into the cloud companies, which, hey, yeah, I wouldn't mind. And it's probably not going to kill their whole business if that goes away, but I would be hesitant at this moment. We talked about it time and time again. I think Oracle, Snowflake, two contrasting takes there, but I would much rather have a management team that's like Snowflake, that's underselling this stuff because they can take advantage if they have that customer relationship. I think it'll be fine. They're not the ones that are building the cloud infrastructure.
No, I agree. You want to talk about Boeing's strike? Which has been a
Yeah.
while. Remember in like 2008, I think it was 2008, when there was a strike and it felt like maybe it was just because of where we are, but it felt like people cared so much, and now it's kind of gone. I don't know. It just seems like people aren't talking about it as much in our neck of the woods.
Yeah, I think it's probably because Amazon and Microsoft dominate the conversation so much locally now, especially Amazon. I mean, just they're the king of clickbait headlines. You write an article about Amazon, it's getting clicked on, and we're going to talk about the return to office stuff here. Um, but with the union strike last time, that's what caused them to move to South Carolina, and it's what the theories are of what happened with the downfall, part of the downfall of getting away from their engineering roots and trying to cut costs. It'll be interesting to see what happens here, but I thought one note from the Wall Street Journal was quite illuminating and potentially scary uh, for shareholders. I guess we've started out being a little bearish on a couple companies, and we got this comment last week that we're being too bearish. And I want to say that, hey, if the market falls, we'll be less bearish, but earnings ratios are high, and we're going to tell it how it is.
Also, I will say we've done a number of episodes here where basically we ended up buying. I think the titles were why we're buying certain companies. So I would definitely say, generally speaking, I hope we're more bullish than bearish, but on the market generally, yeah, I guess we're maybe a little more skeptical.
Yeah. Ooh. Also got a comment about the Hawaiian Alaska merger. I think we should talk about that specifically. Maybe
Yeah.
some points arbitrage for those airline points. I'm gonna get Ryan on that Alaska card. Get him those points. Get him that companion fare. We'll work a trip to Omaha like that. But no, back to Boeing. The anecdote I saw was that the Boeing machinists, who are the ones striking right now, and the most important workforce within the company, the starting pay is $21 an hour before benefits. Amazon drivers now get paid $22 on average. You work at Costco, I'm guessing in the Pacific Northwest where these factories are, you get paid more. And that's not too far high from like a fast food job or something like that. I think that's got to be one of the problems is you're not paying $21 an hour. I want someone who's building planes to be paid a little bit more than that.
Yeah, I'd suspect there's probably more people making above the minimum than you'd get at like a fast food operation or something like that.
Fair. Yeah, that's fair. But
But
either way, if you can get
yeah,
more
that's
at an
low.
Amazon driving job, that's
That
gotta
is way
be
lower than I
impactful.
thought. Yeah.
Yeah, I would have guessed it's significantly higher. than
Yeah, it's interesting. 30,000 workers, that is not the entire workforce for what it's worth, but still a good portion of the machinists. The this could not come at a worse time for Boeing.
yeah.
Like, they are in a cash squeeze. Well, I shouldn't say that. They need to conserve cash, and it's coming at a time when the whole story is, can they increase production? Because there's all these slowdowns going on. A lot of FAA involvement because there needs to be. And so basically all this red tape, and it's just their production, airplane deliveries is down, I believe, 46% from its highs. So it's a high fixed cost business. They aren't delivering the planes they want to deliver because they can't get them out the door fast enough. And now you have machinists walking out on the job. And, it sounds like maybe you can't fault them. The negotiations did not go the way they wanted at all. And I believe it was like 96% of the union voted for a strike versus like 4% that did not. So I I would be so concerned as a Boeing shareholder because I don't think this business is going anywhere. It's critical to the world. But
Stock doesn't have to be worth anything.
I don't see how the stock works out from here, honestly. They have so much debt now. Now it's due in 2062, and I bet they would find a way to get some cheap debt. Some of it's, yes, in general, it's longer duration. It's not like it's coming due in the next 2 years or like they can't service it. But it's just really hard to see how this works out from a shareholder's perspective.
Yeah, I would much rather bet if you're betting on a turnaround for a bloated American company that's getting kind of either disrupted, or I guess Boeing's a little bit different where it almost killed itself in a way. I would rather bet on an Intel turnaround just because of the potential upside, where I think with Boeing, they've generally done like 10 billion in free cash flow when they're humming. And if they get back to that, yeah, you'll probably make decent returns. Maybe the stock doubles, maybe you get a solid total return over the long haul. But Intel, I think, has much more upside if they become the second TSMC, which
Yeah.
which one's more likely? They're both pretty unlikely. I don't know if I'd bet on either, but there's much more upside with Intel, and both have tremendous downside.
Yeah, I honestly just think there's a lot of factors working against Boeing today.
Mhm.
You've got, like, if everything goes right, and that means there's no hiccups, no plane safety issues over the next 5 years. Production slowly continues to ramp up. The FAA's involvement starts to dwindle. So it's like not as much checks and they're able to do things a little quicker. Then they end up paying down their debt. But it's going to be a while until they're returning any of that cash to shareholders. And they now live in a world where they're 30, 40 years ago, they were like the premier spot for engineers in the Northwest, I'd say.
In
At
the
least it seemed
country,
that way.
one of
Yeah.
the premier in the country. Yeah.
They can't compete really, I don't think, on a salary basis with some of the local tech companies here in Seattle, which is still where a lot of their engineering is
Yeah,
done.
it's a little different, but yes, I think that does have an effect. And I think it has an effect on what degrees people go after,
Yeah.
because they understand that before they choose their major.
Yeah. And then the other side, and we saw this with the automotive businesses, having a union is just difficult. It just presents difficulties constantly. If as a shareholder, it might have been the right thing for the machinists. Whenever, I can't remember when the union was put in place, but as a shareholder, yeah, you're it's like TV rights with sports leagues, right? At the end of your deal, they're going to want to take back some of the profits because they helped build it. So you're just going to have to renegotiate and give a lot of that back. So I think they're in a really difficult spot, and I'm staying away from them for
All
the
right.
foreseeable future.
Speaking of the airline industry, we got a comment about the Alaska Hawaiian merger. I should have put that in the notes. I didn't really find much, But I did read that blog post today. Merger, Ryan, got finalized. That Hawaiian flyer bet, not like flyer, like a stock flyer, like, oh, we'll take a small chance and a small position on this one, would have worked out last year. I'm going to show you the flight map. They're essentially merging all the membership programs, except they're keeping the Hawaiian brand just because that's important for, you know, the brand among the islands. Really, it can be a little bit of a separator, I guess. And they're doing some discounts for inter-island stuff that they had with to help with the competition, a membership program for that, which hopefully can help. But I'm going to show you a screen of the flight map. I don't know if it's or can I even find that? Yes. This is now one of the big airlines. And I think I wouldn't be surprised if they kind of dominate the Pacific Ocean. Or at least the northern Pacific Ocean.
Yeah, I agree. I'll tell you what, I'm not interested in Alaska as a combined company now with Hawaiian. I'm just not. But Hawaiian itself ended up being a great investment. And I think we visited it, what, a year and change?
Probably
When
was
we,
about a year ago, yeah.
yeah, we looked at it. And it was basically selling at like liquidation value. And what's it up now? Let me pull this
Oh, it
up
would
here.
be, yeah, it was at like $4 a share. I'll look. It's probably right around 8. Yeah, it's the merger. 18. That was the merger. So would have been
Wow.
quite nice. Quite nice. We didn't predict it. We predicted they were a potential buyout candidate. We didn't think it was going to happen this quickly. But
Yeah.
it's a tough thesis to have that a company is going to get bought out like that, especially when a lot of mergers weren't going through in the industry.
I mean, it kind of made sense. And I don't know if you pitched it or we looked at it together or what it was, but I remember thinking, okay, you've got a valuable customer base that flies regularly with you. You've got planes that I believe were owned. They might have been leased. I
The
think they
new
own a fleet.
787s, they had a
They
good
own,
supply of that. Yeah.
yeah. They had pilots trained during a pilot shortage. I mean, it just made all the sense in the world for a bigger airline to come in and try to pick them up at a slight premium, because if they can get them earning money on a more consistent basis and give them a
And
little
with
more
Boeing,
runway.
Boeing can't get the planes to Alaska. They have that 787. They have it. The existing ones is probably one of the most valuable things they got in this relationship, besides
Yeah.
the fact that now they dominate the outer island. Australia, New Zealand, Japan, and the United States coming to Hawaii. Yeah. Hey, look,
Yeah. But are
airlines
you
suck.
interested in? Yeah, I still don't like airlines. Would you be interested in
Airlines
Alaska
stink.
now?
Yeah, airlines stink, but Alaska seems to be extremely well run. And they've gone from a tiny company in Alaska to dominating the West Coast and now maybe even more. And I don't know how the stock is done over the long term. Let's maybe do a stock chart comparison on them, see what it is. But I wouldn't definitely not bet against them. They just seem to be well run, in my opinion.
Yeah, I just get so bleh with airlines. People are like, oh, it's like the railroads now. They're
The
kind of making that
airports are like the
analogy.
railroads.
Yeah, I just mean that like it's the competition is rationalized and all that, but it's still like consistently competing on cost, and it's very hard to predict what profits are going to look like. You're constantly going to have these huge events that slow it down. I don't know.
Mm-hmm.
I don't love it.
All right. Well, if we look at the total returns from our friends at finchat.io, check them out, finchat.io/chitchat, get a 15% discount. Extremely valuable. Any listener would love them. If we look at them, I don't need to share the screen here, but I just did a chart comparison of the total return since, Alaska's been public since SPY has been a thing. Total return of SPY, 2,181%. Total return for Alaska, 960%. Although I will say, from a good chunk of 2012 to the pandemic, they were outpacing the index. Fine
But
return, but still, look, it's a tough industry.
best performing airline maybe. That's probably not accurate, but great performing airline, still underperforms the index. It's just, yeah, tough industry. What do you think of the Uber Waymo news?
Yeah, someone has a question here. Uber, Waymo, Atlanta, and Austin. I didn't know that they were doing Atlanta. Is that essentially they're doing a new geofenced area there?
Yeah, so they started the partnership in 2023 in Phoenix. Um, and then they just announced the planned launch at the start of 2025 into Atlanta and Austin.
I'm curious what Waymo slash Alphabet sees as the benefit for this deal, because my thinking is you can run a single update to Google Maps that gives a notification to people in that area, and then you can say, download the Waymo app. We have these too. However, I can also see that people already use Uber. There's relationships with credit cards, there's relationships with all sorts of families. A lot of people are locked in to Uber. Now, over the long term, my final thought would be if we get to a full steady state autonomous vehicle, ride sharing, whatever industry, it's all autonomous vehicles, which I think makes sense in major cities. I think the vast majority can be. Like, if it's 5%, why can't it be 50%? I wonder where the value is going to accrue, because under these partnerships, from what I'm aware of, and correct me if I'm wrong, anyone, Uber's managing the fleet. They have to have the storage space. That's the most costly thing from a variable cost, the upkeep costs. Waymo has the vehicles and the software and the hardware, but that's fixed cost up front. I think Waymo can earn a very good, if I'm right reading the press releases that Uber's the one managing these cars, Waymo can earn a nice little profit. I wonder if most of the profits will flow to them, but it's a big TBD. I think, don't know what to think yet.
Yeah, I guess when a consumer starts that sort of digital journey, like you decide, all right, I need a ride share. You're not going to Maps, like that's not really where you start. You basically decide whether or not you need a ride share, and then you go to Uber or Lyft or whatever. Um, so maybe they thought it was going to be too hard to get off the ground in terms of competing from the rideshare perspective. I do like Tyler's comment here. He says this partnership gets access to customers to create knowledge of the brand. Then you can move Uber's customers over to Waymo with cheaper rides. Potentially,
Just
maybe it's
think if you didn't own a car and you had Google Maps and all you did was point the directions thing and then it said, "All right, this is what a Waymo costs. Hop in." Like, it seems like such a seamless update to me.
yeah, but if you didn't have a car, would you really spend that much time on Google Maps?
Well, you're looking for like how far something away is, sure.
Yeah, but
I
I
mean,
feel like
everyone's using
you would
Google.
just start with Uber to see what the pricing looks like. I'd imagine
Well,
if
you
you
have
didn't
to
have a
figure
car.
out where these places are. You have to figure out the distance. Yet, like, no one's
Yeah.
searching on Uber for stuff like they do on Google Maps. I
I,
think
f-
almost everyone that doesn't have a car is still using Google or Apple Maps on a regular basis.
I just feel like you'd start your digital journey figuring out what the price is to get to you somewhere if you didn't have a
Yeah,
car.
but well, you have to figure out where the place is. Like, I guess if you have the address, sure, but I think a lot of people search for the place on Google or Apple Maps, maybe, and then figure out the distance and figure out where something is.
I think you might be overestimating the average consumer. Obviously, the big advantage here if you're Waymo partnering with Uber is you get visibility with customers. I don't see what other value they provide, right? Like they have the reach.
Managing the fleet, you have to keep these stored overnight. That seems like something to me.
Okay, fleet management, but I mean, what you just basically pull a charging facility, and you have them go there at the end of the night, right? Is
Yeah,
that so
well,
tough?
there's a lease. It's a lot of space.
Yeah, I don't know. I think Google could do that on their own. I imagine they're partnering more for the reach, but the either way, it's validity to Waymo as a business, and I think you eventually can start marking this up to something. If you're doing a Google sum of the parts valuation, I don't know what it's worth. And I don't think it's worth valuing at the moment, but it's not, you no longer mark it down as a zero, or even the people that called other bets, that line item on Google's income statement that was other bets, it's no longer a negative value, potentially.
Yeah.
As long
Yeah,
as Waymo's
that's
still
true.
in there.
That's true. I would just there's a lot of people that looked at this partnership announcement as validation that Waymo needs Uber, right? Because there's been a big debate. I don't think this changes who has power over the long term in the ride sharing industry, and it's who has the autonomous vehicle technology. That's where the power remains, or at least the majority of the power is.
It is,
Because they
yeah.
control the destiny. If everyone loves autonomous ride sharing, Alphabet / Waymo can say, all right, take our price or we're pulling. And all your customers will be upset. It's similar to a content provider
Sure.
on almost a cable TV thing, where it's like, okay, well, we have the power. Everyone wants to watch ESPN. Sorry, the fee's going from $5 to $6.
Yeah, I think I think that makes sense. And if there were a big tech company that I had faith could build a successful consumer app, it's probably Google. I mean, how many of their apps have more than 1 billion users? I think 8, something like that.
No, 15, Ryan. Oh no, 15's over 500 million. Yeah, I think you're right with 7 or 8. Yeah.
Like, I'm sure they could be successful doing it. What are you pulling up here? Uber's valuation?
Uber EV to EBIT might be a little bit wonky. 78. Uber EV to free cash flow. I would watch out for SPC there when calculating this. 35.6. Are you in or out?
I'm not in. No. I was, yeah, I know this means nothing, but I was really interested when the price, we visited it a while ago. The price was a lot lower, and it seemed like they were on the path to higher profit margins. I can't remember why I said no. Maybe it was just that I thought they were too spendy, but I'm less interested today.
Here's a good question. Maybe final question on this segment. What happens when Waymo undercuts human drivers on the Uber app? And I think that means on cost. That's a great question because they're like a hive mind of choices that can set some price, I think. But Uber sets all the prices. I would love to understand the relationship there, because eventually you would think without the driver you can have a lower cost on a per ride basis or per mile or whatever it is. And that to me means that, like, who wouldn't choose this? It's the same place. You don't have a driver that might be, Uber drivers have that stereotype of being extremely annoying, or at least 20% of them trying to talk their ear off about their entrepreneurial journey, or something. Or obviously, there are concerns there. But on the cost front, even like if it's cheaper, it feels like they will have unlimited demand as long as they're a small part of Uber's overall pie, and they grow to a bigger and bigger pie, and then we see what happens.
Yeah, it's also, if we're geofencing it in, it's probably a small fraction of the rides on Uber's platform.
Definitely globally, yeah. But within those cities, it can be a high percentage.
Yeah, but you're probably also getting a lot of drives into the city, kind of thing. So, it has to be, start to destination has to be within that geofenced area.
Mm-hmm.
I imagine that's still a small fraction. If you're an Uber shareholder, does this make you more comfortable about the Waymo risk long term?
Yeah, I mean, slightly, but I don't think it moves the needle too much. I still think there's major uncertainty there. It's like a slight improvement that they want to work with them. But again, it comes back to, for me, who holds the power over the long term.
Okay, let's talk small cap of the week.
Yeah, and I want to also talk Amazon's back to the office, which people were upset about. But why don't we're halfway through the show before you hit the small cap of the week? Do you want to talk about our friends at Public once again?
Sure thing. You heard us talk about them earlier in the show, but if you want to earn a 6.9% yield for the next 4 years or more, you need to check out the bond account at public.com. It's a new way to invest in a diversified portfolio of bonds and receive monthly interest payments. Best part, if you act now, you can potentially lock in a 6.9% yield until 2028. The new bond account only at public.com/Chit Chat Stocks. Our small cap of the week. This was recommended by a listener, and it was Dave. Ticker is DAVE. And so you sent this over to me, and I was like, "This is great." Like, I've been looking at David Buster's a couple of times now. Actually, read a couple of reports on them. This is fantastic. I can't wait to dig in. That is not the company. The company is literally Dave. It's Dave Incorporated, which I can honestly say I've never heard of in my life. So what do? Well, as the small cap of the week presented by Yellow Brick Investing, I looked up the ticker on joinyellowbrick.com. It is a repository for great investment pitches. This has actually become a literal part of my process every week. Anytime I find a small cap I haven't heard of, I literally just look up the ticker, and I found a high quality write-up in this case on Yellow Brick on the ticker Dave. And I'll just go through and read the first line of that write-up. So I know I'm kind of ripping this off, but then we can kind of give our our takes on whether or not it's something we're interested in. It says Dave is a fintech company that offers digital financial products to financially challenged Americans. Its main offerings are extra cash, an early wage access loan, and a digital checking account designed for people living paycheck to paycheck. Payday loans, more or less.
So like friendly or won't break your arm payday loans.
Yeah. And I kind of got the ick. What was the term you used last week? There's an odor from it.
Yeah, smells bad. Like
you know how people get the ick? That's like a thing now. Like girls get the ick or
some
whatever.
sort of TikTok thing. Yeah, girls.
I get that with certain investments where it's like something doesn't feel right. And it's just like the area, the lending to challenged Americans. It's just like if something goes wrong, how much credit risk is there? Is there like any sort of banking relationships that are a big issue here? So it's basically sort of an Upstart. If you remember Upstart from kind of 2020. Upstart the company.
Yeah, I was gonna say not figuratively an Upstart, and then I realized you were talking about the real one that I'd forgotten about for about a year. Well, that's not great. Are they talking about AI? How they're gonna be an AI beneficiary?
I didn't go through that much of the investor relations materials. I assume they mentioned AI, but basically, yeah, it's like automated loan decisions, which is fine. But I'll go on here a little more. The short-term early wage access loan has 0% interest rate compared to the 30 to 300% APR charged by legacy payday loans. It doesn't charge late fees either. It says the majority of Dave's revenue comes from a non-mandatory express fee of about 3 to 5% of the loan size. Instead of waiting for the 3 to 5 days for the money to arrive, borrowers can access the money instantly if they pay the fee. So
take rate,
these,
right?
What's that?
Take rate. That's what it is.
Not, yeah,
or
but almost in the way of Venmo. Like, so if you know you're getting your paycheck coming up in 2 weeks. You need money today, though. You can't afford groceries. You can take out an early wage access loan from Dave, and if you pay 3 to 5%, you get it instantly. If you wait, you get it in 3 to 5 days. But keep in mind, these people are pressed for cash; they need the cash. So a lot of people opt in for this 3 to 5% fee, and then you end up paying it back quickly. It's like within 2 weeks, right? It's they connect to your bank and just see when your payday is, and it's owed like the day after you get paid or whatever, or maybe it's like 2 weeks from whenever you get the loan. So it's really quick duration loans, 0% interest, but more often than not, people are taking they're taking the charge on the little fee just to get the money instantly It's very important to note too, Dave does not originate the loans themselves. They have a banking partner called Evolve that performs the loan originations. Dave just brings them the volume. So I was concerned about this going in when I saw it was a financials company. I was like, oh God, I'm not going to be able to analyze the. You can't analyze it, but with some of these fintechs, it's really hard to like figure out what's the proper valuation to use. That's not the case here. It's mostly fee revenue. There's not a whole lot of credit risk. It's actually a little easier to value. So you can look at it on sort of an EV to gross profit basis, or maybe an EV to whatever we think forward earnings are going to look like type of valuation. It really is very similar to Upstart here. There is, you've got, like you're not taking credit risk per se, but you have risk with your banking partner. So in this case, yeah, it says, I think Evolve might be under investigation. So apparently there was a big, I think the company was called Synapse, like last year, that went, they had a huge accounting problem, and their banking partner got like bore the grunt of it, is essentially what happened. And so they're cracking down on a lot of these fintech accounting practices, and Evolve, as the banking as a service provider, received a bunch of consent orders, and everyone's worried that Dave is going to lose their main banking as a service provider here. So I don't really understand that relationship that well. I don't understand if Dave would be able to switch to another bank. I don't know if Evolve, if the concerns are overblown here. So there's sort of some key man risk, if you want to call it that, or key supplier
Yeah.
risk.
The business model might be deemed illegal, and they got to get a banking license.
It's not like
They're not
nothing
too.
Dave is doing here is wrong, in my
I know,
opinion.
but it might be deemed they might not want in general this type of relationship to happen. That's my
Correct.
concern.
Let me just go through some of the numbers just to paint a picture for anyone that's looking at it. Market cap, $460 million for Dave. I'm talking about Dave here. Last 12 month sales, $293 million. Operating margin last quarter, 7%. But they just kind of turned the corner to profitability, so they could get to higher margins quickly.
Maybe,
The
yeah.
difficulty here, and I'll just go out and say I'm not interested in this. I'm not going to dig a whole lot deeper. The business model for me seems very fragile. The small caps of the week that we've looked at in the past that I was interested in, none of these are going to be ultra wide moat businesses, but I want the ones that aren't highly dependent on any one thing, because if that does go away, and in small cap land, it goes away all the time, or if you lose a supplier, you lose a customer, whatever it is, it's a huge risk to the business model and your investment. So, yeah, the relationship with Evolve is kind of concerning to me. The area that they lend in, I don't love. It's just not one that I'm going to dig a whole lot further on.
Yeah, and so you say, okay, they have 0% interest rate compared to 30 to 30, 100% APRs for the traditional one. Why? Have they made some innovation that can make them give the worst borrowers 0% interest? I don't know. I think that's concerning, because there's no amount of AI or technology that can solve for someone being able to pay something back like that. They don't charge late fees. That's fine. They have that express fee. I think that it just seems like, in which, again, with same as you, I'm not going to investigate any further. It seems like potentially flimsy revenue, where someone goes, hey, look, I got to go to this solution. I need my money now. Okay, I pay 3 to 5% of it. I have to take the hit. I need the money. But is that a recurring relationship? I don't know. Is that a healthy
No, but there's a
relationship? Are
huge
you going to be able
market.
to upsell to any other?
I would say there's a huge market.
Yeah, that's true.
I don't know. There's a lot of difficulties here.
These
One thing
loans
is, okay, so
cannot
they don't
make
take
sense
credit
for
risk.
Evolve. This cannot make sense for Evolve.
I agree.
I'm sorry.
But apparently the delinquency rates are like 2%, so it ends up working out. But the issue
Okay.
is,
All right.
Yeah, the
I'm
issue is if
skeptical
something happens in their algorithm that miscalculates or they lose whatever and delinquency rate rise, Evolve will cut off volume to them. The same way Upstart, everyone's like, Upstart doesn't take credit risk. They're fine, even if loans go bad. That's fine, but the banks stopped pulling volume from them.
because it wasn't performing. Yeah.
Yeah, so it's just not something I'm interested in. It's also not an industry like lending to this cohort of Americans is not it's not something I either want to learn that much about or know that much about to begin with. Maybe I can learn more. I just how many great payday lenders have there been in
I don't
terms of
know.
like
No, no.
performing businesses?
I hear there's one ticker that used to get thrown around called CACC,
Oh,
uh,
okay, yeah.
Credit Acceptance Corp. I think that's been a great performer over the long term, but besides that, I don't know.
I know there's one. It's like Go Easy Financial or something like that in Canada.
Hmm.
Maybe there are a bunch, but whatever. I guess I missed them. Yeah, so I'm going to pass on this one. Although this inspired me to look at Dave and Buster's next week, and I will give another shout out to Yellow Brick Investing because a whole bunch. I was able to get up to speed on Dave, and maybe I'm don't know the business that well still, but able to get up to speed so quickly by literally just looking up a ticker on joinyellowbrick.com. It has stock pitches from all across the internet, and they're high quality write-ups, high quality pitches. Highly recommend going and check it out. You can get a discount using joinyellowbrick.com/chitchat for any of the paid plans. And you get real time, like I think it's a month or 2 month delayed on the pitches if you're on the free plan, which still tons of value there. But if you want more real time stock pitches, you can upgrade to some of the paid plans. Very affordable.
Yep, it's a great service, which is why we use them on every show. And yeah, I was gonna mention Dave and Buster's. Could be a fun one, and it looks like it passes through that market cap. Well, below the market cap threshold for the small cap of the week. You want to talk? I'd say let's close out with we had that emerging markets question on Twitter. We'll hit that too, but maybe first Amazon's return to office. A lot of people in the chat comments here asking about it. What'd you think? I think firstly they said they saw that Seattle was number 2 in traffic to Los Angeles, and they said we got to be number 1.
Yeah, that is a real bummer. For anyone that lives in Seattle, if you don't live in Seattle, traffic is a nightmare. So
we can be number 1 though. I think we can be better than LA.
We're gonna get there.
Let's get there. We'll get there someday.
So forcing people to go back to the work, going back in office it's a huge. It really is kind of a huge ask. But I love all the people that are like, shame on you. You better be working hard for me. Like you should be going to the office. You get paid well. And they're just like, they work remote or they don't have to experience that. I will say, I feel for the employees that signed up potentially under false pretenses that they thought, actually, I met someone, I want to say like a month ago who lived out on the peninsula and
Across the water.
That's a long ways away for anyone that's not from Washington. You got to take a ferry and they bought a home on the idea that they could work remote or that they could maybe do 3 days a week in person. That's a huge ask for them to go in person every time. So what you're going to get most likely is probably a lot of voluntary resignations, voluntary layoffs, if you want to call it that, people that want to work elsewhere, which if you're an Amazon shareholder, potentially some cost savings there. And I don't think you have to pay severance.
That, at least in the short term, that is good for shareholders.
Do you have any concern that, are you an Amazon shareholder?
No, we were back in the fund. If it gets cheap enough, I'll be back. But let's get past this AI expectations, and then we'll get there, if that makes sense.
Would you be concerned that they're going to lose engineering talent?
I don't think that's been their big advantage either way, maybe excluding AWS because the brand has been Google to be the premier one that people started Amazon and moved to Google for premier engineering talent. I don't know if that matters too much, but I do know that I here's what I think is most important. Getting rid of oh, we just had a comment pop up here. Getting rid of the Alexa division and possibly Project Kuiper.
What are your takes on the every time we talk Amazon, you boycott Alexa. What are your takes on the 5 days in office?
On the 5 days in the office, yeah, it's a forced layoff, like, it makes sense. Or sorry, stealth layoff, where they're gonna convince people to quit. Now, do I feel for them? A little bit, but if you knew that this was potentially going to happen and you get paid over $100,000 a year and you have great benefits, I don't have too much sympathy for you. Like, okay, you gotta go in, it's tougher, blah, 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 it's okay. But, hey, I don't think it changes much, and if they keep looking to cut costs, that's fine with me because I read this morning in an article in the journal about the cost cutting that they have 350,000 corporate employees, and I don't think do they need to have that high ever again? I think we could strive to never reach that level ever again.
Yeah. Yeah. Maybe. It it's
That's
so hard
excluding
for
for
these
anyone.
companies not to just keep hiring.
Okay, for anyone in the that's listening, that is excluding the warehouse. Warehouse is like over 1 million. So this is office corporate people.
Question for you. Do you think office corporate people ever overtake warehouse employees
Oh
in
God.
terms of numbers?
I hope. Yeah, I mean, I hope not.
Automation,
Man, you
robotic
can automate
automation
more.
throughout the warehouses,
Yeah, you can automate the corporate jobs by putting all these email senders on Chat GPT.
self-driving delivery trucks.
Self-driving delivery truck. Yeah. Hey,
I guess
look.
those are all contractors mostly, right?
Yeah, I'm not sure exactly who's defined as an employee, but they are one of the biggest robotics people for the warehouses. Hey, you could be right. How about combined? Let's try to. Doesn't seem like these people are too happy to work for you anyways. So let's win, win, win. Win for shareholders, win for management, win for the people that want to stay, win for the people that want to leave. Let them go.
What segment of Amazon's business that is not one of the big ones? So not retail, not AWS, not trying to think of the other ones that
The
are.
third party slash prime.
Yeah, I kind of throw that in with retail, but Prime, I guess. What are you most optimistic about that could actually
Advertising
deliver? Okay, I kind of bundled that in with retail, but
is
are you
logistics
saying
costing.
what about advertising outside of retail, like outside of
Yeah.
on Amazon?
Ooh, you mean like Amazon Prime Video? Yeah, be bullish on that. They've set up a pretty good offering where, yes, they've lacked versus Netflix on their original stuff, but they have a ton of consumption across free and, like, okay, watch this movie. It's on Prime, or you can rent it on here. It'll have ads. I think there's a lot of room for that. I'm not sure how big that'll be, but advertising in general, yeah. But if
What
you
about
you're like, what besides cloud and besides this retail stuff, which will include all the different spokes around
I
the
know.
retail hub, it's kind of tough to say. But Project Kuiper, no. Hardware, no. I mean, they've all been busts. Besides ever since the Kindle, nothing has worked in
You
these
don't think
things. And
Project my only concern with Project Kuiper, like I love in theory, I love the business at scale. Like it seems like it worked great. It's going to be very costly to get there in the meantime,
they're far
and not
behind.
certain. Yeah,
They're
and they're
very
far
far
behind.
behind.
So you're just saying cut all the cut all the other bets.
Well, Yeah, I'm trying to think of what the other bets are. Remember, like they did an update on the Astrobot. What?
What's wrong with the Astrobot?
It will probably cost $1 billion a year to maintain that RMD. Or is it called the Astrobot, or is that a game that I just saw?
I have no idea. I don't know what that is.
Amazon Astro. Yeah, look that up.
Okay, I will. You want to talk emerging markets?
Yeah, so we had a question here. Actually, we had a comment here in the chat that said, "Guys, what about some Swiss gems, Nestle and Young?" I'm not going to pronounce that. Don't know if you're playing a joke on me, but that could be a real name. Yeah, Nestle seems fine. It's
I
fine.
don't like European companies. I said it.
Yeah, except
Don't like the
LVMH.
reporting. What?
Except LVMH and the Nordics, and except if they're Swedish.
I'll take Swedish.
Let's
Swedish
talk
cereal
about emerging
acquirers.
markets and
Yeah.
international markets. Sweden makes the cut in Europe, or Europe excluding Sweden, we're out.
Yeah, I don't know. It's just unless you're like a Hermes, I just don't love like unless you're a luxury brand. Yeah, I'm kind of Hermes, Ferrari, LVMH. I'll exclude the rest of them. It's usually like if it's the same company in the U.S., same company in Europe. For some, well, I guess at least you have lower costs in terms of development talent in Europe. But I just get, I don't know. Maybe it's like the shareholder returns ethos doesn't seem quite as comparable to the U.S.
I agree. Yeah, you got. I mean, we have some comments here. Yes, there's comparisons. ASML Booking.
Booking's not
There are
European.
a lot of that has U.S. exposure. We're talking like.
But Booking is a U.S. company doing business in Europe.
Yeah, exactly. So the argument is you got someone like Unilever, someone like Nestle. I don't know what their earnings ratio are, but the argument usually is, well, they're at a lower earnings ratio. Okay, but they're not levering up and buying back stock. So why do I care? Why does it deserve to go to 25 times earnings? I don't know. Now, if it was at 8 times earnings, okay, let's talk.
But it never seems to get. I feel like it doesn't get I think sometimes they kind of have a similar philosophy to Japanese companies around like not being too aggressive. A lot of them are family run, want durability, want longevity for the business, not trying to optimize for the short term. That's fine. But the Japanese companies trade at huge discounts. I don't really see that as much with the European companies.
Mm-hmm. Well, not as big of a discount. Now,
Yeah.
let's get to the question. The question was essentially, what's your take on emerging markets this week? I don't know exactly what they mean. Like, do we have a prior take on them? But I'm just gonna pretend like it's in general. What's your take on emerging markets? And I would say, I guess Japan is not an emerging market, but I like Mexico and I like Japan.
It might be emerging in terms of its valuations, hopefully.
Remerging. Yeah, it's emerging is like its valuation, or like the United Kingdom, the remerging market. Because it's turning into an emerging market. I heard an English person say that, so I'm not trying to bag on the English for that, but
No, we have a
that's what I
ton
heard
of
someone say.
and we have a ton of listeners in the UK, Australia, and Sweden, and really in some of the Nordic countries. I will say, Sweden seems to be maybe sort of a tech hub potentially.
I think it's just they just have long-term mindset. And speaking of which, Ryan, someone had a theory once. This was a great Reddit theory of why. I know we've kind of been Seattle homers today of why so many great companies have been started here. And the theory is that we've had such large Nordic and Japanese immigrants as a percentage of the population over the last 150 years, and those cultures are focused on long-term durability. I like that as a
I
theory.
thought you were gonna say bad weather.
Oh, but maybe I think that's
Keeps
why
them inside. Keeps
I
them
think
working
that's why they
hard.
came here though at the start because the weather matched up. But yeah,
Yeah. All right. I like the theory. Emerging markets that I like probably Mexico. I like as well. I don't love most of the South American markets, although I do think you can find some really good discounts there. for companies that, especially that have like, that are functionally monopolies and almost like government run monopoly, like what's it, Petrobras in Brazil. I think you
or the
can get
Colombian
huge
equivalents.
discounts.
Yeah, I know there's one that was like the Panama City Airport / Panama Airline. I thought was interesting. There's some Chilean ones that are interesting. Colombia as well. Argentina, I think there's an airport there that's interesting, although that one's more risky than most. Argentina obviously is in quite the turmoil. I'll tell you one that I'm not interested in, and it's simply because it's a market I don't understand, and the stock market is booming, and that is India. I'm not saying
I
it's a
agree.
bubble, but when people are saying, well, the Indian stock market's soaring, you got to get on this. It's a growth story. It's a growth story. That makes me a little skeptical as an outsider.
Yeah, it's a market I haven't studied much at all, to be honest. We're running up on time, but what are the markets that are easy excludes for you?
India at the time right now, especially because valuations.
China.
Or China. I'm trying to think of ones that actually have open markets that we could invest in. Maybe the Gulf countries, given I think you technically can invest in some of those. Possibly. I mean, I think you can go into Egypt too.
Yeah.
I guess Western
I'm
Europe.
open to most. I'm open to most.
Yeah.
Like the right company, right product, right business. It doesn't matter where it is, as long as, unless it's like I feel like I won't get any capital return to me, I'm comfortable with it.
Yeah. No, I agree. As long as the rule of law is fine, but you need a higher margin of safety in a country that you don't understand. Now, Mexico, I think I understand a little bit more than India. It's a lot, like, just as an example. But even in Mexico, I'd want a margin of safety. All right, Ryan, as we're closing out here, the Fed just announced its interest rate. What mumbo jumbo? Do you want to predict? Was it 25 or was it 50? You're not looking.
I thought there was a letter sent to the Fed that it needed to be 75. Wasn't there something like
from
that?
those senators that couldn't predict that they needed to raise aggressively in 2022. Yeah, good job
From
by
the
them.
acting politicians.
Yeah. Okay.
It's a good thing
What do you get? 25 or 50? A little coin flip.
25.
50.
Home builders. Let's rip. Let's ride.
Yeah, there you go. Yeah, I'm guessing the home builders rip, but I'm guessing Ally, not so much. All right. We'll probably talk about the impacts of that next week, or maybe not, because, you know, it doesn't necessarily
It's
matter,
boring.
and it's boring. Yes, exactly. But I think that game was kind of fun. All right, let's hit the disclosure. We're going long. Blah 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 blah. We are not financial advisors. Anything we say on this show is not formal advice or recommendation. Ryan, I, or any podcast guest may hold securities discussed in this podcast, may have held them in the past, and may buy, sell, or hold them in the future. We have a comment here saying Chit Chat Macro. Yeah, maybe spin off a whole show. That's what we'll make all our money. Talking gold, Bitcoin, macro, all that good stuff. But yeah, thank you everyone for tuning in. These go live every Wednesday, 1:30 p.m. Eastern time. You can watch the replays on YouTube, listen to the replays on YouTube, or listen to the replays when they come out Sunday mornings. Spotify, Apple Podcast, Overcast, anywhere you get your podcasts. All right. We'll see you next time.